Good evening, participants. Welcome to today's webinar on Equity Market Insight, where our experts share the updates and insights on global and domestic markets, equity market valuations, and their outlook. And we also deep dive into one of our fund's strategy. I'm Sonal Mittal, product specialist at UTI Mutual Fund, and I'm joined by two industry veterans, our CIO, Mr. Vetri Subramaniam, who will take us through the market updates, and our head of equities, Mr. Ajay Tyagi, who will share his insights on UTI Flexi Cap Fund. Please post your questions on the link provided to make the most of this opportunity. Without further ado, I will now invite Vetri to take over. Thank you.
Thank you, Sonal. Delighted to have everybody back here join us again for the Equity Market Insight, March 2025. And of course, today we have with us Ajay Tyagi, who's the head of equity at UTI and also the manager for the UTI Flexi Cap Fund. And that's, of course, the fund that we are going to be talking about in more detail today. So I'll just jump straight into the presentation as we always do. And what we try and do is first sort of, stitch together some of the broad macro thoughts that we are seeing around the world, which are important trends that we should be aware of, because it is also changing some of the economic frameworks that we have become accustomed to in recent times. What I'm not going to do is talk about the tariffs, because honestly, at this point of time, we are in some kind of an escalation matrix where, the US has certainly decided to use tariffs to achieve many of its goals, including foreign policy goals and economic goals. But this is resulting in tit-for-tat actions from other countries. And really exactly how this will play out is impossible to predict. I don't think anybody has a clear handle on which businesses could get impacted, how much they could get impacted, and whether the impact is only a negotiating tactic for a quarter or two, or is more sort of long-ranging. So very hard to discuss that topic, but we can already see some broad trends which are starting to play out. And the first trend that, on the global landscape that I think that we need to think about is really that the US has decided to back away from its role as the geopolitics policeman of the world. And that change by the US is causing, I would say, fairly cataclysmic shifts in the thought process in Europe. It is resulting in a significant willingness on the part of Europe to increase its spending, and particularly on defense. If you look at the slide over here on the left-hand side, you can see the size of the military budgets of the US, followed by China, then by Russia, and then you've got some of the other key countries across the world, including, of course, some of the European countries. Now, you can understand very much that one of the big conflicts in the world is currently the Russia-Ukraine conflict. And think about it, Europe has actually been the centerpiece of many conflicts during the 20th century. But in effect, Europe had outsourced its defense and the military spending to the US. But given this new paradigm that we have in economics and in geopolitics, the European economies will likely have to increase their military spending. On the right side, you can see Germany military expenditure as a percentage of US military expenditure. And you can see there that prior to 1989, which is when the Berlin Wall came down, Germany used to spend a lot more on its own defense. But, post 1989, as the threat perception of the Eastern Europe and Russia started to come down, they reduced their expenditure. The US continued to spend quite aggressively. And therefore, countries across Western Europe, including, of course, Germany, actually cut back on their expenditure. Now, Germany has a new government which is likely to come into place shortly. But even before they've come to power, they've actually reached an agreement with the party which currently actually runs government to take two very momentous decisions in the German parliament. One involves spending a significant amount on infrastructure within Germany. And the second is to let go of what they used to call the debt brake, which effectively placed a constitutional ceiling on fiscal deficits to say that, in effect, any spending on defense lies now outside the purview of the fiscal brake, so to speak. So, in effect, this is Germany, the powerhouse of Europe, By the way, it's the only G7 country which runs a very conservative fiscal policy. Debt to GDP is about 60%. Fiscal deficit is, closer to 1%. But now they're clearly saying the gloves are off and we're willing to spend more. And that is a big change in trend that we are likely to see. And which is why actually defense stocks in Germany and in Europe are actually the best performing sector in global markets year to date, simply because of this change in perception. So moving on from this, which is this issue, coming back to India. Now, of course, we've already seen the GDP growth, for the quarter gone by, come in at, 6.2%. This is the GDP number for the December quarter. And this is an improvement from the 5.4% that we saw earlier. But really, the big picture that I want to share with you is the red line that you see in this chart. The red line tells you whether, the fiscal deficit and the trajectory of the fiscal deficit, is it coming down? You can see that the fiscal deficit reduction in 2026 is much more muted than the fiscal deficit reduction in 2025, when the fiscal deficit was compressed by almost 1%. When you compress the fiscal deficit, it actually has the impact of a negative impact on the economy. Now, I'm not talking about the prudence of, bringing down fiscal deficits over the long term, but just on an annual basis. An expansion in fiscal deficit is an expansion in growth. It's seen as expansionary. A reduction in fiscal deficit in the very short term is really contractionary. That impulse is much more limited this year. Also, interestingly, note that the green line, right, that green bar, you can see the bars here for 5 years. If you notice, that green bar is actually in the positive territory in 2026. The reason this is happening is very interesting, which is really the government. This is reflecting the change in personal taxation that the government announced in the budget, which is effectively putting close to 1 lakh crores back in the pockets of households. And now it is up to them to decide how they wish to spend this money. And, it can be argued, and I think it would be correct to argue, that households are eventually far better arbiters of how resources should be used than the government. And secondly, the return on investment and the productivity gains from private investment by households has a far more positive impact than government, where there is a significant amount of inefficiency in their spend. So not only is the negative fiscal impulse reduced, but you've also got this positive impulse on the economy, which is actually revenues being left in the hands of households, which they could use to spend, they could use to save, or they could use it for, paying down debt, all of which are very good uses from the household's point of view. So this is it as far as India is concerned. The negative stress from GDP is reducing, and we'll talk about it later, but also the negative from monetary policy and RBI's administrative actions is reducing, but we'll talk more about that later. So moving on to the next slide. Now, FDI, what is the importance of investment in a country like India? Country like India, investment is basically the driver of our GDP growth. And we've got two sources of investments when we think about the private sector. One is the private sector, and the other is foreign direct investment, because these are typically seen as very long-term investment. Now, the black line that you see there is gross FDI. And you can see that this number was continuously rising. There was a little bit of a slowdown in 22-23, but the number is again up in the first 9 months of FY25. This, mind you, is the gross number. The reality of FDI money in India is that a lot of our FDI comes not through companies choosing to invest money in the local economy, but it comes through private equity funds and venture capital funds. And these funds at some point of time choose to liquidate their investments and repatriate money back to where they raise the money from. So you can see over here that one of the things which has held back net FDI in India, net FDI is nothing but the gross FDI minus repatriation on account of sale of investments by such investors. There has been very significant repatriation by foreign investors. I should add that it's not just repatriation by private equity funds and venture capital funds. Remember, in the last 2 years, we've also had some large global companies who have chosen to either list in India or they have actually reduced their stake in their Indian businesses, and that would amount to a repatriation of FDI money. So we do have net FDI coming down, which would have some kind of a dampening effect on investments and overall positive impact on the economy. But keep in mind that this is a number which gets affected by market movements. And when you see the market selling off by 20% almost in US dollar terms, I think it's very natural to expect that sale of investments by people who qualify as foreign direct investors would actually likely come down. And therefore, this pace is likely to reduce, and net FDI most probably should start to go up slightly from here. It's a self-balancing mechanism, particularly as far as valuations are concerned in this equation. So hopefully from here, there should be a net positive impact from FDI, and the worst of the negative impact of repatriations is now behind us. Finally, moving on to the next slide. This is on currency. Now, I see a lot of talk, the currency, which was rock solid to 23 and early 24, has obviously been weakening. You can see that pattern over here, where somewhere between 22 and 20, the late 24, the currency was rock solid, and then it starts to decline. But look at it from a much longer trajectory going back to March 2020. Really, the story in global currency markets has been about dollar strength and dollar exceptionalism. And as a result of that, all emerging currencies have been weak against the dollar, which is why you see that EM currency line in blue. It has actually been falling much, much faster. So yes, the INR has depreciated over the last 3 to 4 months, but when you look at it in a longer term comparison relative to the peer group, our currency is not doing anything which is particularly concerning. It is reflecting the dollar strength, and we'll see how these policies from the US in terms of trade and tensions eventually play out. It could undermine the hegemony of the dollar, though I think that's a very long-term trend, but certainly it will to some extent halt the trend that we have seen of dollar strength, particularly the dollar strength that was visible after the election of Mr. Trump. That has actually started to halt or go into reverse over the last 20 to 30 days. If that trend persists, then hopefully we will see some stability in all EM currencies, including the rupee. But the big picture is that the rupee has actually done reasonably well. So we'll just jump through now to the slides on equity markets, valuations and earnings trajectory. So the current estimate for the Nifty 50 EPS is that earnings would grow about 9% in FY25. There is a little bit of a back-ended fourth quarter element in this, but really the best period for earnings CAGR in India in recent times happened between 20 and 24, when earnings compounded at almost a 19% CAGR over that 4-year period. You literally have to go back to 2003, 2008, where you find that 5 or 6 year period where earnings compounded at 23%. So we are coming off the base of very strong earnings growth. The 9% number may still have some risks associated with it. The good news is that the number for FY26 has started to moderate. I say good news because you don't want a market where earnings expectations are unnecessarily elevated. Last 2 years, GDP growth in India has been closer to 10 to 11% average. In that context, a 13% earnings CAGR is not a disproportionate number as compared to the 15-16% number we were looking at earlier. So again, I'm not saying this is an easy number to get to, particularly given a lot of the chaos which is going on around the world, which I said very hard to capture that in terms of the impact of earnings in the short term. Market is more likely to react by reflecting it in valuations, because it's impossible to figure out where that earnings number is. There are just too many uncertainties for us to have a high confidence forecast. Jumping through to the valuation slide. If there's anything which is increasingly looking very, very clear, it is these two slides, or rather this slide, which has got 2 data points on it. And of course, there's one on the next slide. You look at the trailing PE ratio of the Nifty 50 reflective of the large caps. It is now comfortably in that fair value zone, right in the middle of the fair value territory, approaching the average. Forward P still not near the average, but it has also dropped into the white zone, which is the fair value zone. You look at the next slide, which shows you the Nifty price to book. Once again, it has dropped comfortably into the white territory, which is the fair value zone, still slightly elevated relative to the average. But I think the message from large cap valuations is that the sell off in the Nifty of about 15-16% from the peak has brought the valuations back into fair value territory. It is not cheap, right? I mean, that green zone is where it becomes cheap, but at least this is a zone in which you need not worry about putting your foot into the water at this point of time, because it is in the fair value zone. And there are multiple ways in which you can manage risk. We'll talk about that when we talk about product and investment strategy towards the end. Moving on to the next slide, this talks about mid cap and small cap valuations. We've been highlighting this in our recent calls. Mid cap valuations, even after the fall, remain quite expensive relative to the fair value zone. They are still in the expensive zone. Small cap, slightly more interesting. On the right hand side, even I was surprised to see this. It's actually just dropped back to the borderline of fair value and expensive. So it's sitting right there at the borderline. This is data as of the, I think the 3rd or 4th of March. So it's right there at that zone. Just 2 points to make. I would still say, compared to the large caps, I would normally expect to see this at a discount. It's not yet gone to that territory, but just relative to its history and partly because the last 3 years valuations have been so elevated, it has pulled back to the borderline of fair value and expensive. So again, we'll talk about more of preferences later on, but the broad message is in this equity valuation index. Again, our equity valuation index at UTI is a reflection of what we think about large cap valuations, because it is based on the Nifty 50, the price to book, the price to earnings, and then of course the dividend yield, and then the comparison to bond yields. So when you look at this, it is now actually dropped into the increased equity allocation zone. And the two funds that we run, which rely on this model for equity allocation, which is our multi-asset fund and the balanced advantage fund, go back to the beginning of this year. Their equity allocations were closer to 50% as we speak today. As the market has come down, and more importantly, as valuations have come down, the equity allocation in these strategies has moved closer to about 63-64%. That's a reflection of the equity valuation index and the message that we are deriving from the equity valuation index. Now, why is the equity valuation index important? You can see that on the next slide, right? This just shows you the average return that an investor can hope to earn on a 1-year basis, depending on which zone that they invest in. And when you invest in that increased equity allocation zone, which is where the market is currently, the average return has been 14%, though there's still a lot of variation between the min and the max. Min is as low as -21, max is as high as 52. But on average, this has been a reasonable zone in which to enter, as compared to the decreased equity allocation zone where the market was 6 or 7 months ago, where the average 1-year return is just about 2%. Also, look at the bottom 2 rows. 57% of the time when you invest in the market in this zone, your returns tend to be more than 12%, which I would define as the attractive threshold for investing in equity. And the chances of a negative return are actually as low as just 6%, which is why we think from a probabilistic framework, and all asset allocation is eventually probabilistic, the odds as far as large caps are concerned are now very much in favor of investors. So finally, just moving on to the last slide, and to sort of conclude, there are significant risks from US tariffs and the tit for tat responses that we are seeing across the world. This poses a growth not just to earnings, but to entrepreneur confidence, their willingness to invest. And therefore, the US markets are actually now starting to worry that they could even be facing a recession. What 2 years of high interest rates and tightness by the US Federal Reserve could not do, it would appear that the uncertainty caused by the actions of the US administration could actually trigger a slowdown, if not a recession in the US. And this is a risk to the US because remember, all other components of the global economy, at least so far, are not in great shape, right? China, we know, is struggling. Europe still struggling, though at the margin. If Germany and some of the other European economies increase their spends, it might have a net positive impact, but it's still early days, and we know Japan has its own challenges. So really, the two big global economies doing well were US and India, and now we've got the US also to worry about. I talked about US GDP growth. High frequency indicators are still mixed, which is why I would say, the 7.5% GDP estimate that the MOSPI has put out for the fourth quarter is still a little bit of a high bar. Let's see how that plays out. I talked about this earlier when I mentioned that in India, fiscal policy impulse is now less negative than it was, though we remain conservative in terms of monetary policy. A very big change is happening as far as RBI's actions in the banking system are concerned. They are taking significant measures to improve durable liquidity in the system, and they are backing away from the administrative measures that they took in 2023 to reduce credit growth. Please remember that credit growth is like lubrication and fuel for the economy. They have slowed it down from 18% to 10%, but now they seem to indicate comfort for credit growth to pick up. And I think if you want the economy to grow, you will have to see credit turning more supportive. And I think there has been a inflection point in their thought process there, which will be positive for growth. We've already talked about the equity valuation index, which is, entered the attractive zone. Nifty midcap still very unattractive. Small cap index coming to touch the fair value zone. But as I said, I'm still uncomfortable there given the premium to the large caps that we see. Consensus earnings growth 13% for FY26. Possible. It's not a very high bar, but neither is it a low bar. We still think asset allocation and risk management should be the focus. Why? Because of some of the reasons we already articulated. There are challenges to earnings at this point of time, and therefore risk management should still remain, core to the investor's thought process. Our number one recommendation for lump sum is in the hybrid strategies, but our UTI balanced advantage, multi-asset and equity savings funds. And of course, some investors may also want to look at the aggressive hybrid, which tend to run with a static equity allocation. We think there are very early signs. It's actually visible now in the data over the last 1 year, where there is a trend inflection point from value towards quality growth. And we think this trend has more distance to run. In the large caps, our preference across large, mid, and small, therefore, is for large caps. But we would recommend to stagger investments. That's the best way to go about it. So that's about it in terms of the macro perspective and where we think the best investment opportunities lie. I'll halt at this point and hand over to Ajay. And I think some of the points that I've talked about will actually segue quite nicely into UTI Flexi Cap Fund, and how Ajay, who's been running the strategy very successfully for more than a decade, and has been running the UTI Flexi Cap Fund for coming up to almost a decade, and has done it in very disciplined fashion. We should be entering a phase where there should be an opportunity to harvest that style for alpha over the next few years. So over to you, Ajay.
Yeah, thank you, Vetri, and good evening, everyone. So we'll go straight in, and I'll just take about a minute to recapitulate what the UTI FlexiCap Fund stands for. So the preamble of our strategy is to basically focus on quality businesses, which we define as companies that have high return on capital, have strong cash flow generation, and therefore have low to no debt. So essentially, we're talking about very strong companies which basically generate wealth for their investors because of the intrinsic value that they create, and over time grow this intrinsic value because of a very strong growth outlook in their franchise. So starting point for us is quality, but we always try and marry quality along with growth. And growth for us, again, has a definition which is not just cyclical growth, but structural growth, by which we mean that the drivers of growth should remain relevant and valid for about 5 to 10 years. What doesn't excite us is growth over the next 1 to 2 years or 1 to 3 years. What excites us is growth that actually has a very, very long runway in front of it, and where the drivers are evident and visible to us. So the portfolio is constructed at the intersection of both quality and growth. And like I said, We feel that such a portfolio requires huge amount of patience. The alpha generating ability of such a portfolio is built around these businesses creating and compounding intrinsic value. It's not related to our ability to buy them cheap and sell them high, or our ability to find trends in the market to catch those trends and then take advantage of those trends by going in and coming out very quickly. This strategy is really a strategy which requires patience. It starts with identifying great businesses, and it requires huge amount of patience in terms of holding on to such businesses. I also want to very quickly summarize on the valuation bit by saying that this is not a strategy which is growth at any price or quality at any price. We are conscious about valuations all the time. And therefore, some of you who've been invested in the strategy would have observed that sometimes we take many quarters, maybe more than a year, to build meaningful positions because we are always waiting for the right valuation for the businesses that we have zeroed in on. Yeah. Let's move on. Whatever we said and discussed in the last slide is actually quantified here in front of you. So we call ourselves as high quality, high growth. And obviously, as investors, you should want to check whether the portfolio indeed is high quality and high growth. So here are some numbers. So each of these vectors represents at the top the profile for the portfolio, and immediately below is on the same vector, what are the outcomes for the benchmark. So for instance, when it comes to revenue growth, the portfolio has grown in high teens across long time periods. The last 3 years, like Vetri explained, we came from a cyclical low, so therefore the entire market and most portfolios have seen a very strong growth. But if you look at the benchmark has been in low teens. So there clearly has been a 3 to 4 percentage point outperformance in terms of revenue growth by the portfolio across time periods. When it comes to profit growth, a very similar picture here. There is a 3 to 5% higher growth across different time periods and certainly over longer time periods. Quality ultimately has to be represented by return on capital employed. The third vector from the top is basically return on invested capital. As you can see, the ROIC profile of our portfolio is about 10 percentage point on an average higher than that of the benchmark. Finally, quality also manifests itself into low to no debt. In fact, cash sitting on the balance sheet. Many of these high quality businesses have huge amount of cash. As you can see on the last vector, which is debt to equity, our portfolio has a negative net debt to equity, which means these are net cash companies compared to the benchmark, which on an average has about 0.3 to 0.4 times debt to equity. So very clearly, this one slide objectively with quantification of different vectors, showcases the fact that indeed our portfolio through the cycle has been high quality and high growth. Yeah. Interestingly, while it is high quality and higher growth, as you saw in the previous slide, but the portfolio actually has a lower risk profile compared to the benchmark. If you look at the top, the standard deviation of the portfolio across time periods, this number has been lower than the benchmark. And ultimately, it boils down to the kind of companies that we are holding in our portfolio. Like I mentioned, these are companies with very strong balance sheets. These are companies with high cash flow generation. These are companies with stability of margins, and indeed such businesses across cycles remain fairly stable in terms of their stock price behavior as well. Next. We'll now quickly discuss the reason for the underperformance of our portfolio over the last couple of years. But I want to start by saying that over the last 1 year, the portfolio has had a significant high single digit outperformance against the benchmark, which is Nifty 500. And also in terms of quartile rankings has moved on to quartile 1. But yet we also want to discuss what did lead to this phase of underperformance in the fund in 2022 and 2023 and the first half of 2024. So here are those names where we are very bullish, where our portfolio is overweight. And we are bullish because of the fact that these are businesses which are displaying both high growth, as you can see in the first two columns, the revenue growth over a 10-year period, as well as PAT growth being, high teens to maybe even beyond that in certain cases. And in terms of return on capital, again, being high teens to beyond that. So very, very strong businesses across cycles. We've been bullish on them because of these characteristics. But if you move on to the next slide, you would realize that unfortunately these businesses have underperformed and underperformed to the extent that while the whole market is still trading at a slight premium to its long-term averages, in case of mid caps, a significant premium to long-term averages, but these businesses on an average are trading at a discount to their long-term averages. So if you look at the column in the middle, which shows premium stroke discount to the 10-year average, you would realize that whether it's LTI, Mindtree, or DMart, or Grindwell, they're all trading at a discount to their averages, and Titan and Astral are just at the average. So, in a sense, despite these businesses doing fairly well, there has been a derating of sorts, and this goes back to the style rotation that we've been always discussing. That there are pockets of time when the market clearly favors one particular set of companies, one particular part of the market at the expense of the other. The last 3 years have been extremely punishing for quality businesses. And despite markets making a significant high in terms of its earnings multiple, many of these businesses have been trading at a long-term discount. Now, if you move on, these are the set of companies which we don't own. As you can see on the extreme right column, we have zero in them. We don't own them. But these companies have actually done very well. The reason that we don't own them is either they have a muted growth profile, or if their growth profile is strong, their return on capital is not strong, or the outlook is patchy, or maybe the industry itself is extremely volatile, like the aviation industry. So again, not checking the boxes on our core preamble, which is looking for quality which is sustainable, looking for growth which is sustainable. If these boxes are not checked, we don't end up owning such businesses. The list in front of you is basically a list of companies which are either missing in quality or on growth, in some cases even both. And that's the reason we didn't own them. But the stocks have done very well. And as you can see on the next slide, actually the valuations for most of these companies is actually at a premium to their long-term averages. In case of a couple of them, a slight discount to the long-term average. So in a way, what we have owned for the right reasons haven't done well. Their valuations have got derated. What we have not owned, again for reasons they don't fit into our philosophy, have done well, and their valuations have got re-rated. To our mind, there will be a mean reversion. The mean reversion has just about started. We've held our portfolio very steady, as we'll show you subsequently. And we feel that by remaining steady in these businesses, which have one of the best abilities to compound intrinsic value, we should be rewarded in the coming years. Yeah. Now, Warren Buffett has this very short quote, which obviously is very simple. It resonates with everyone who's been in the markets, but unfortunately is not so easy to implement. Warren Buffett and his partner Charlie Munger used to always say that investing are also very, very simple rules of investing, but not easy to implement, because in the marketplace, what is always in short supply is patience. Investors usually are getting either too excited or are getting too frightful or too despondent, and therefore they can't stick with what they ideally should be holding on for a fairly long period of time. So this simple quotation is about simple quote is about investing for the long term by thinking about great businesses and lengthening the time that you stay with such businesses. And according to him, and we all would agree with this, that you can create wealth that you would have never thought of. What we see on the next slide now is nothing but a quantification of the previous slide. So we've taken 6 businesses. All 6 are great companies in their respective fields. Asian Paints, HDFC, Nestle, I would call them as high quality and strong growth companies. SBI, Tata Steel, Tata Motors, great businesses, but I wouldn't particularly call them both high quality and high growth, because the first three are the ones which have a much better ability to compound their intrinsic value over long periods of time. Therefore, their returns over the past 30-year period have been significantly higher than those for the bottom three companies. So all six companies are great. Three of them have a much more solid business model, high quality business model, ability to keep compounding earnings at a higher rate, and therefore, if one stays with them for the long run, the returns obviously would also be great. Yeah, move on. Now, this is the top holdings of the portfolio. As you can see, this portfolio has a very high active share, almost 70%, which basically means that we are bottom up. We're not looking at what's there in the benchmark. We are constructing the portfolio basis what we feel has the best potential to create alpha over the next 5 years, and not necessarily trying to hug the benchmark or trying to stay close to the benchmark. Obviously, this has its own biggest one being that if certain large caps or large holdings within the benchmark do well, which we are not owning at all, then the portfolio underperforms relative to the benchmark. But our guiding pillar always is that if you have a collection of great companies, then rather than looking at them and looking at their stock prices in comparison to the benchmark every now and then, one should only be testing one's core hypothesis that whether these companies are still high quality and high growth, and whether the outcomes over the next 5 years are still expected to be great. If the answer is yes, then we just continue holding on to them. Yeah. In terms of, I'll draw your attention to the right-hand side. In terms of key sectors, let me just cover that in the interest of time. Financial services, although underweight, is the largest part of the portfolio at 25%. We are very big on the consumption side, and thankfully, the budget, which clearly is now pedaling hard on reviving consumption and personal consumption expenditure in the economy, bodes very well for our high weightage towards the entire consumer sector, whether it's consumer services, which is 15% of the portfolio, or consumer durables, which is 10%. The consumption basket put together across different lines for us is an overweight of about 20%. In a way, this was also the reason why, one of the big reasons why we underperformed over the last 3 years, because clearly consumption has not done well over the last 3 years, whereas the capex oriented sectors have. But we also feel that there could be time for reversal, both on account of high valuations for the capex-oriented businesses, and also on account of the government's tilt towards driving consumption in the economy. Yeah, next. A very short quote once again by legendary Charlie Munger, which is that the big money is not in buying or selling, but in waiting. Believe you me, waiting is the most difficult thing. Most investors are extremely itchy. They just feel that if they haven't done any activity in the day, then they haven't done justice to their role, their profile, and the evidence is obviously to the contrary. You ought to be holding on to your great businesses rather than buying and selling into them all this while. And if you see the next slide, we've done exactly that. Our portfolio turnover ratio remains lowest in the industry, on an average at about 10%, and we are not changing that. Of course, we are always looking for businesses which are not part of our portfolio and are looking great. Maybe these are some companies which have just IPO'd 1, 2, or 3 years back. So we are always looking at what's great and yet missing in our portfolio, but we're not looking at jumping around and trading within our portfolio just because the market feels that in the short run something could be rewarded or something could be punished. Yeah. I'll now cover the last 2 or 3 slides on this topic that we have covered many a times over the last 2 or 3 years, the value and quality rotation. Vetri alluded to this. You've seen this chart multiple times. The yellow shaded parts signify value outperformance. The purple shaded parts signify quality outperformance. As you can see on the right hand side, the yellow shaded area in terms of time frame is the longest ever over the last 20 years. And the value part of the market did exceedingly well over the last more than 3 years. That also led to certain quality oriented funds like us underperforming. The good news is this has started to reverse. If you very carefully see on the rightmost part of this chart, the purple is started to form once again. And in fact, from May of last year, quality has started outperforming value, and cumulatively over the last 9 months, quality has outperformed value by about 10%. So that's visible in the market. In a way, that's also leading to our fund doing better over a 1 year period. The next slide is basically a very interesting one. Please allow me a minute to first explain the whole thing before I finally tell you what are the conclusions of this study. So first of all, this study has been done from a period of 1st April 2005 to 28th Feb 2025, 20 years really. We've picked up 4 different indices: Nifty 500, which is a broad market, quality index, value index, and the mid cap index. For each of these indices, we have picked up daily values, and on the basis of these daily values, on a rolling basis, we have created 1 year returns, 3 year returns, and 5 year returns. Because the time interval is very long, even for 5 years, on a rolling basis, there are 3,700 observations. So, very large sample set. Margin of error reduces whenever the sample set is large. We have tried to reduce the margin of error even further by not looking at only one time period, but testing the hypothesis by looking at 3 different time periods: 1, 3, and 5 years. Uh, the other part of this study was to basically, first of all, define the market into 3 distinct phases: a bullish phase, and we have identified, or we have called out, a bullish phase as one where markets are giving more than 15% return on an annualized basis. Then we've called out a bearish phase as one where markets are giving negative returns, again, all the way up to 5 years. So it's really a bearish phase. Finally, a more normative phase. You would have heard many of us talk to you about the fact that what you can expect from the Indian markets is just about a 12 to 14% return. So that's a more normative phase, which is in the middle. Now, let me come to the final conclusion. The conclusion here is that whenever markets are bullish, whenever animal spirits are out, whenever people are loving to take risk, mid caps do better than large caps. And the value part of the market, which basically means businesses which essentially may not be very strong, but may be enjoying, but may have the ability to enjoy a cyclical high in the coming years. I'm sorry. So, so such kind of cyclical businesses basically have the potential to get re-rated over time. And therefore, during such phases, the value part of the market does well. If you go to the other extreme, which is a bearish market, I'm sorry, this is a phase where people are now becoming risk averse. They want to come out of weaker businesses, go into the more quality part of the Vetri, can you complete? I think this is the last slide. Can you just complete this slide for me?
Oh, yeah, sure. Yeah. So I think Ajay has got a bad cough, so I'll just sort of take over on this. And I think really the big point we are, looking to make over here, and this is obviously in the context of the UTI Flexi Cap Fund, is that the quality growth approach that we use in Flexi Cap sort of tends to drive very consistent returns over time, which is what you can see over here. That if you look at the return of that quality 30 vis-a-vis the Nifty 500, it is quite consistent over all time periods. It's when that the market returns are, super over very short term or even medium term phases, these tend to be driven not just by earnings growth, but also by a change in the valuation multiple. And that's when value tends to, have a very strong performance because it's benefiting from the change in valuation along with the change in earnings. Whereas something like the flexi cap, which focuses on quality growth, is primarily looking as the driver of its returns coming from the intrinsic compounding in earnings that those companies are doing. This is something, if you recollect the earlier slide Ajay showed you, he showed you the return on invested capital and the 10-year outcome in terms of earnings growth for the kind of companies which are in the flexi cap fund. And what you can see over there is that those return outcomes, or rather the earnings outcomes over very long periods, have been very consistent. So in the flexi cap fund, that is what we are trying to do with this focus on quality. And it's this quality which offers the consistency in the returns. So maybe we can just halt this part of the presentation here, Sonal, and we can open it up to questions. And happy to take whatever comes along. If Ajay's throat recovers, he can take some of those, or otherwise I can take whatever questions come up.
Sure. Thank you, Vetri and Ajay, for sharing the insightful updates and perspectives. We now open the floor for questions. Let's start with those we have already received while we welcome more from the audience. So, Vetri, the first question goes like, while you said you don't want to talk more on the tariffs, but my first question is on the tariffs only. Investors are jittery by tariff uncertainty and escalating prospects of trade wars, making the market drop unsurprising. Many economists now warn of a US slowdown or recession. How serious is this fear and what impact could it have on the stock markets?
As I said, this is a fast evolving situation. Even President Trump, his views in the morning seem to be different from the views in the evening. So it's virtually impossible to figure out what the impact of any of this is going to be, which are the policies that they will stick with, or rather, which are the tariffs that they will stick with. But the immediate investor reaction to this will be to start placing a lower multiple on earnings simply because they no longer feel confident, and therefore the visibility of earnings start to go down. So you will see some market multiple compression, and that is what has perhaps already started. But I will just point out that, look, in India, the sell-off in the markets actually started way back in September, and people like us have been talking about a rich market all the way back in early 2024 as well. So sure, sometimes concerns come along later, but we can only be guided by what we understand. And in my opinion, what we understand is the historical pattern of valuations, and therefore that is what we should be guided by. We will never be able to predict unusual outcomes like, who will be the president, what kind of policies they will adopt, will there be COVID, will there be a global financial crisis, or for that matter, will there be a boom in emerging markets like 2003, 2008, or will we see a fantastic turn in India's growth prospects as we did during 2014, 2024. All of these things can be forecast after the event. They can't be forecast before. So when you're dealing with so many uncertainties, our thought process is always focus on your financial goals, focus on your asset allocation, and that asset allocation needs to be guided by valuation. Today, the large caps are back in the comfort zone. That is what use that to take your decisions rather than trying to second guess things that we have no ability to second guess.
Thank you, Vetri. My next question is to you. FII outflows continued in February with net withdrawals exceeding 1 trillion from Indian equities in the first 2 months of 2025. Where do you see this trend heading in the coming months?
See, when you put it like 1 trillion and all, it sounds like a very big number, but let's keep in mind that foreigners own, more than 20% of your market, right? So their total ownership in the market is somewhere between 750 to $800 billion plus. In fact, more than that, if you include the ADRs, is my guess. So when you look at it in that context, the amount of money that they have removed is only, 2-3%. It's not really, in my opinion, all that big an amount, some amount of rebalancing. Secondly, never look at things in isolation. You have to always look at it in the context. The context, as I said, is that dollar has been strong. Bonds have become a very viable investment asset in people's portfolios. So there is an exit of money towards bonds, particularly US bonds, and there is an exit of money from many equity markets around the world into US equities, because the US equity market till 10 days ago was literally like the only game in town, and it's 60% of global benchmark. So who wants to take a risk over there? So we have suffered, foreigners have withdrawn money, but foreigners have withdrawn money from many markets. So my view is that when the valuations turn more reasonable, and certainly they have turned more reasonable, you will start to gradually see some more stability in foreign patterns. And remember, as I said, particularly this trend of sell down from foreigners, FDI, FPI, VC, that will slow down simply because the reduction in prices will automatically reduce the selling over there.
Sure, Vetri. Ajay, if you can take this question, while you have covered a lot of it during your coverage on the fund has seen a phase of underperformance. The fund's recent performance has improved. However, what has led to the underperformance, and how do you see it going forward?
So, Sonal, I tried to cover it during the presentation. The overarching reason, if you ask me, is that we've been a very high quality oriented and quality tilted portfolio. I'm sorry. As a consequence, we have been overweight on certain sectors, but equally missing out on a few sectors, and that's by design. It's not as if we got it wrong in 2022 and 23. By design, the portfolio is unable to find businesses coming in from sectors like energy, utilities, infrastructure and construction, industrials. We do have some industrial names, but we're not overweight on industrials, and industrials as a sector has done very well. So have the other sectors that I called out. But it's by design. And by design, we've been overweight on consumer services, consumer durables. We've been overweight on IT, and these sectors haven't done well. We've been overweight on private sector banks. And we still are very, very positive about them. But over the last 3 years, private sector banks, except for ICICI, haven't done well. So, it's the construct of the portfolio which is heavily tilted towards quality, which has led to this underperformance. We did see that slide where we were talking about the style rotation, value having beaten down quality absolutely hollow over the last 3.5 years. That's something which obviously has been a big cause for our underperformance. But there are early signs of reversal of this. The fact that we've held steady in terms of the core complexion and texture of our portfolio, to our mind, has helped us in the last 12 months, because as the pivot moved away from value into quality, our portfolio, which was sitting right there, got lifted and therefore showed much better performance in the last 12 months. And these are trends which carry on for a few years. They just don't keep rotating every 6 months. Yeah.
Thanks, Ajay. Vetri, the next question is for you. Earning growth in past couple of quarters has been muted. What are the reasons for this slowdown, and what could be the driver for the revival?
So I think the slowdown in earnings growth that I said earlier is a very simple function of eventually what is the economy growing at, right? Because when we talk about GDP growth, we are talking about how the nation's income is growing, and the nation's income is growing. That is the income that people use to spend, which gets captured as the spending side of the GDP. So, when you've got an economy which slows down to 5% GDP growth, obviously the number of companies which are able to grow in nominal terms, let's talk in nominal terms, at above that 10%, 11% number starts to come down, and then automatically, therefore, earnings growth has to slow. So the big point to keep in mind is that over a very long period of time, there is a significant correlation between revenue growth, earnings growth, because that's a subset, and GDP growth. You cannot have a divergence between these two numbers for a very long period of time. And I know most people think that earnings will always keep compounding faster than revenue growth and therefore faster than GDP growth. But keep in mind that as investors in the stock market, what you're concerned with is earnings per share growth. And in an economy which is growing fast and which needs investments to grow, there is always a impact of dilution which is happening because the number of shares is going up, and therefore, that will also impact the trajectory of EPS growth and GDP growth. So net net, weak GDP growth makes it very difficult for businesses in aggregate to create output numbers which are very, very different. Sometimes it does happen because individual companies may be gaining market share relative to their competitors, but the aggregate number cannot change. The other thing which might be changing is maybe consumers are changing their spending patterns. This is something we have seen recently. Consumers have been spending more on experiences, and they have not been growing their consumption of goods at the same pace. So you've seen this change take place in the market where consumer services industries are recording better earnings growth as compared to consumer goods companies. So these are sub trends that play out, but eventually remember that the stock market is a slave to earnings growth, and there is some correlation between earnings growth and GDP growth. Though, as I said, keep in mind that eventually dilution also matters. And that is why capital intensive businesses, you need to be careful about interpreting their growth potential because their growth requires large amounts of capital and that capital can often be diluted.
Thank you, Vetri. Ajay, my next question is for you. Uh, since market has seen sharp correction, do you see any opportunities to add in the portfolio? Which sectors or themes are you currently bullish on, or which are the ones that you are avoiding?
Sure. Son, the first part of your question, absolutely yes, there are opportunities that are emerging now and across the board. But if you look at by and large caps have already reached to a level which is within striking distance of the long-term averages. So they're already into the fair valuation zone. So the opportunities in large caps are certainly more. Even within mid caps and small caps, selectively there are opportunities. Some stocks, and as it always happens, have obviously fallen much more than the index itself. So we are finding opportunities there as well. So yes, last 10 days in general, I would say that we've been picking and choosing stocks across the market cap segment wherever we think the valuations have already corrected. They may not have bottomed out, or they may not have reached to a level which is extremely attractive in terms of prices. But yes, coming within the value zone itself is something which is drawing our attention. Last part of your question, what are we avoiding? What are we loving? So, Sonal, I showed you that our portfolio has a very low churn. So what we are loving are the same themes and the same sectors that we were loving about a year, 2 or 3 back. What we don't like are again the same sectors. Anything which is cyclical is what we try to avoid. And by the way, there is another reason to be now negative on cyclical sectors, because as we all know, global growth is taking a beating. And it's going to be harder for global growth to stay at the level at which it has been post-COVID. And that's not good for commodities and cyclicals in general. Yeah.
Thank you, Ajay. Considering time, I will take one more question, and that is related to you only. You are overweight on IT sector. What audience wants to know is there is a lot of jitters around the globe, and many global brokerages have downgraded US equities. What is your view on this sector, and should one stay bullish or take a cautious stance?
So with any investment thesis, there is always a short term and always a long term. At UTI, we want to look at the long term, and we want to just overlook the very short term. It's not easy because obviously life is lived in the short term, but what matters the most in terms of outcomes is what your view in the longer term is. And why I've just given you this backdrop is that in the longer term, IT companies will stay relevant for decades altogether. If you look around yourself, everything is being driven by IT one way or the other. So obviously in different shapes and forms, new set of technologies will come. businesses would want to implement those new set of technologies, and the partners who would be implementing these new technologies for them would be the IT services companies like Infosys, TCS, Coforge, so on. So over the very short term, yes, exactly 2 months back, somebody would have said US is turning the corner, recession fears are behind us, US is still doing well, inflation is coming down, and IT is one of the favorite sectors. And that's why most IT companies made life highs, and IT was one of the best performing sectors. Come Trump, that narrative has changed. Now suddenly IT is a bad boy in the short run. Who knows when this view would once again change? Maybe April, maybe October, we have no idea. So the short term keeps changing. What drives us, what drives our conviction, what allows us to remain patient is always the longer term hypothesis, which is what we keep testing. And our hypothesis is still getting validated as of now, as I speak. IT is going to stay relevant, and that's why we are slightly overweight on IT. Yeah.
Thank you, Ajay. On behalf of UTI Mutual Fund, I extend our sincere gratitude to all our viewers for participating today and asking questions. We believe that today's session provided you with enriching insights on equity markets and UTI Flexi Cap Fund. We hope that your queries have been answered to your satisfaction. Please share your feedback on the link provided. Special thanks to our esteemed speakers, Vetri and Ajay. With this, thank you and good day.
Thank you.
Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.